Hello, everyone. Welcome to a second lesson on financial literacy. This one, we are talking about financial statements. So let's kind of get right into it. I'm going to switch over here so that you can see my screen. And there we go. All right. All right. So first off, let me ask you, are you a fan of books, movies, or sports? Well, if so, chances are you have heard or said the phrase spoiler alert. Now, it is used to forewarn readers, viewers, or fans that the ending of the movie or book or outcome of game is about to be revealed. Some people prefer knowing the end and skipping all of the details in the middle, while others prefer to fully immerse themselves and then discover the outcome. When it comes to running a business, people often do not know or understand what accountants produce or provide. That is, they are not familiar with the ending of the accounting process. But that is the best place to begin the study of accounting. So, in financial statements, we have to realize that there are four financial statements. Accountants create these financial statements, and the financial statements are reports that communicate the financial performance and financial position of the organization. The overall purpose of the financial statements is to evaluate the performance of the company, governmental entity, or not-for-profit entity. Each financial statement has a unique function, and together they provide information to determine whether a company generated a profit or a loss for a given period of time based on its assets, which are resources of the company, and its accompanying liabilities, which are the obligations of the company. Assets and liabilities are also used to determine owner interest in profits or losses, as well as the current cash position of the company. So, the four financial statements that perform these functions and the order in which we prepare them are the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Now, the order of preparation is important as it relates to the concept of how financial statements are interrelated. So before explaining each in detail, let's explore the purpose of each financial statement and its main components. So, the purpose of the financial statements. Before exploring the specific financial statements, it is important to know why these are important documents. And to understand this, you must first understand who the users of the financial statements are. So the users of the information found in the financial statements are called stakeholders. This is someone who is affected by the decisions, actions, or policies made by a company. These include the investors or the owners, creditors, lenders, the employees and the managers, regulators or governmental agencies, and customers and communities, and suppliers or vendors. Now, the common goal of using the financial statements is to understand the information each contains that is useful for making financial decisions. The complete set of financial statements acts as an X-ray of a company's financial health. By evaluating all of the financial statements together, someone with financial knowledge can determine the overall health of a company. An accountant can use this information to advise outside and inside stakeholders on decisions, and management can use this information as one tool to make strategic short and long-term decisions. So let's start looking at each of the financial statements, starting with the income statement. This is a statement that shows the organization's financial performance for a given period of time. The income statement can also be visualized by the formula revenue minus expenses equals net income or net loss. Net income is when revenues and gains are greater than expenses and losses, and net loss is when expenses and losses are greater than the revenues or gains. Next is the statement of owner's equity. This is a statement that shows how the equity or value of the organization has changed over time. Similar to the income statement, the statement of owner's equity is for a specific period of time, typically 1 year. And remember that equity is the value of an item that remains after considering what is owed for that item. So let's look at an example. Suppose a family purchases a home worth $200,000. After making a down payment of $25,000, they secure a bank loan to pay the remaining $175,000. What is the value of the family's equity in the home? Well, if you answered 25,000, you are correct. At the time of the purchase, the family owns a home worth 200,000, an asset, but they owe $175,000, a liability. So the equity or net worth in the home is only 25,000. Now, the elements of the financial statements shown on a statement of owner's equity include investments by the owners. This increases the value of the organization. It also shows the distribution to owners. This is the decrease. Shows the decrease of the value of the organization. Net income or net loss is also shown on the statement of owner's equity. This is an example of how the statements are interrelated. Next is the balance sheet. This is a statement that lists what the organization owns, its assets, and what it owes, its liabilities, and what it is worth, the equity, on a specific date. Notice the change in the timing on the report. The income statement and statement of owner's equity report the financial performance and equity change for a period of time. The balance sheet lists the financial position at the close of business on a specific date. Next is the statement of cash flows. This is a statement that lists the cash inflows and cash outflows for the business for a period of time. Now, at first glance, this may seem like a redundant financial statement. We know the income statement also reports the inflows and outflows for the business for a period of time. In addition, the statement of owner's equity and the balance sheet help to show other activities such as investments by and distributions to owners that are not included in the income statement. But we have to realize that there are two bases of accounting used to prepare the financial statement. One is the source of cash, where the money comes from, such as jobs, allowance, or any other way of getting money. And the use of cash, where the money goes or what the money is used for, such as purchasing goods and services, savings, or expenses. So we have to think, is cash being used to make an interest payment on a loan, or is cash being used to purchase a large piece of machinery that will expand the business capacity? Now, continuing on with the statement of cash flows, there are methods of accounting. There is cash basis accounting. These are transactions, for example, a sale or purchase, that are not recorded in the financial statements until there is an exchange of cash. This type of accounting is permitted for nonprofit entities, and small businesses that elect to use this type of accounting. Then there is accrual-based accounting. This is when transactions are generally recorded in the financial statement when the transactions occur and not when paid, although in some situations, the two events could happen on the same day. Knowing the difference between the cash basis and accrual basis of accounting is necessary to understand the need for the statement of cash flows. Stakeholders need to know the financial performance as measured by the income statement, that is, the net income or the net loss, and the financial position as measured by the balance sheet, that is, assets, liabilities, and owner's equity of the business. This information is provided in the income statement, the statement of owner's equity, and the balance sheet. However, since the financial statements are prepared using accrual accounting, stakeholders do not have a clear picture of the business's cash activities. The statement of cash flows solves this inadequacy by specifically focusing on the cash inflows and cash outflows. All right, so that is our lesson on financial statements. Our second lesson on financial literacy, which is talking about the financial statements.